Welcome to Dr. Fred Markets. This is not financial advice. While most people ignore what's happening in the markets, a few choose to pay attention. And that difference, that simple choice to stay informed, changes everything. You're one of them. Let's get into it.
Wall Street is quietly preparing for AI riots, not AI profits. This is not financial advice, but here is the truth. The stock market's AI story just cracked, and no one on TV wants to say it because their sponsors are long Nvidia. Signal 1. The S&P 500 closes at 765, up a polite 0.28%, while Nvidia bleeds 0.56% to 198.45. Translation: the AI mascot of this entire bull run is slipping while the index grinds higher. When the poster child lags the herd, that's not rotation, that's the market whispering. We don't trust your fairy tale multiples anymore. AI has been the liquidity vacuum cleaner for 2 years. Money left everything boring to chase chips, models, and AI-powered whatever. Now the index rises without its AI warlord. That means two things. Passive flows still pump the S&P, and active money is quietly tiptoeing away from pure AI exposure, like they smell smoke in the server room. Signal 2. While everyone doomscrolls politics, the real story in those headlines is power and fragility. A power loss at BP's Whiting, Indiana refinery helps jam Illinois gas prices higher in the middle of a hot Iran war backdrop. One broken node in a tightly wired system, and real-world prices go nuts. That's your AI future in one chart. Hyper-optimized, hyper-profitable, and one random outage away from chaos. Energy volatility is a direct tax on margins. AI isn't just in the cloud, it runs on electricity, cooling, and physical infrastructure with the same failure modes as a refinery. You like 40x earnings on AI hardware? Fine. Now add, what happens when grid stress and geopolitics hit your data centers like they hit Midwestern refineries? Signal 3. Punchbowl reports Tillis and Alsobrooks hammering out a stablecoin yield framework, while Spirit Airlines drama and Mayday arrests clog San Francisco and SFO. Politicians scream on TV about protests. In the back room, they quietly engineer pipes for programmable dollars and AI-compatible money. That stablecoin yield deal is not a crypto story. It's an AI story. Programmable, always-on money is the operating system for algorithmic markets. You want AI trading everything 24/7? You need instant settling, dollar-like instruments that don't wait 3 days for some boomer clearinghouse to wake up. That's what stablecoins deliver. When Capitol Hill stops pretending crypto is fake and starts engineering yield rules for it, they are not experimenting. They are laying tracks for machine-speed capital flows. Here's the cliff. The market is rearranging itself for an AI-run financial system while the AI stocks themselves start to wobble. Everyone is buying the actors while the stage gets rebuilt underneath them. So connect the dots. Nvidia underperforms while the S&P inches up. The AI narrative is no longer a single stock hostage situation. The index says, fine, if Nvidia prices in sci-fi perfection, we'll just pivot. Banks, energy, industrials, boring.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Stuff that benefits from AI quietly, without TikTok hype. AI is leaving the hype phase and entering the plumbing phase. Profits shift from the movie stars to the pipe fitters. Energy chaos from a single refinery outage is a preview of AI fragility priced into US stocks. Markets finally learned that just-in-time everything explodes under stress. COVID, supply chains, now refineries. AI is just-in-time logic on steroids. It pressures grids, raises capex, forces new data centers, and drags regulators into the party. That cost doesn't show up in your favorite AI TAM slide, but it will show up in margins and sector rotations. AI winners in the next leg are the firms that monetize productivity without betting the farm on brittle infrastructure. The stablecoin yield deal is the smoking gun. Washington is not trying to kill AI-driven markets, it is trying to domesticate them. Stablecoin rails plus AI trading equals a US-controlled, always-on casino where algorithms move dollars at machine speed while regulators keep the scoreboard. That's insanely bullish for US stock market dominance and brutally clarifying for AI. The real alpha is in controlling the rails, not LARPing as the next Nvidia. So here's the conclusion nobody wants to say. The AI trade is migrating from shiny chip stocks into the dull bones of the US financial system, and if you're only staring at Nvidia's ticker, you're already late. For you, that means three things. First, treat pure AI stock exposure like late-stage rock concerts, not religion. Nvidia closing red while the S&P is green is the market flashing. We love AI. We hate overpaying for it. In an AI-obsessed market, the real trade is AI enablers inside broad US stocks, not just the loudest AI brands. Second, watch infrastructure and rails, not slogans. Data centers, grid upgrades, exchanges, brokers, payment networks, and yes, anything touched by stablecoin regulation. That's where AI quietly fattens margins. The headlines scream protests and airline rescues. The money follows power, pipes, and payment logic. Third, stop pretending the US stock market is old economy. That stablecoin yield deal is Washington wiring AI into the core of the dollar system. The S&P 500 at 7/2065 isn't just an index. It's becoming the default AI collateral pool for the planet. AI runs on compute, energy, and trust. The US controls all three more than anyone else, and the market is repricing that reality in real time. This is not financial advice, but here is the truth. If your entire AI exposure is one ticker and one story, the US stock market will make money off AI. You will just be the exit liquidity. If you want more of this unvarnished, no excuses market surgery, subscribe, hit like, and share this with the friend who still thinks AI just means buying whatever CNBC says 3 times an hour. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.